Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, March 1st, 2017. Investors, despite actually setting records for the Dow, Dow finished up over 21,000 by the Wednesday weekend. Investors actually pulled out $6.2 billion from the conventional fund business. So that's kind of an amazing thing. You know, really, I'm surprised that we didn't see more money coming into open-end funds because it was the 12th consecutive time, it was the 12th consecutive session during the flows week that the Dow actually saw record-setting closes, and so that was kind of an amazing feat. Obviously, we all know that investors took the foot off the pedal ahead of Trump's session with the joint sessions of Congress, in which he was addressing people. Were just going to do a wait and see to see if he himself imploded, which he obviously did not, and sent again the Dow to some strong numbers above 21,000. I think it was 21,115.55. But really, we heard some really good news as well during this week. Consumer spending was on the rise. We saw new home sales coming in at 3.7%. So again, a little bit of a head scratcher that we saw negative flows. We'll give you the details on how that occurred by looking at our macro groups. If we look at the group, we see equity funds lost about $1.3 billion. Taxable bond funds took in about $1.2 billion. Muni bond funds saw about $200 million in outflows. That's the first time in like 8 or 9 weeks, so that's kind of a change. And money market funds, which was the pariah of money outflows, was $5.9 billion in outflows. Well, let's take a look at the equity universe to see how it panned out and kind of why I'm scratching my head during this presentation. We saw that the average equity fund actually had a 0.81% return for the week, so it was positive. Fourth consecutive week that we've seen positive returns on a Wednesday basis. And then we saw that $1.3 billion came out for the third consecutive week. We've seen outflows out of that group. So again, investors are apparently just really scared about the new highs that we're making, and maybe they're doing the proper thing, just pulling back and sitting back and waiting to see what happens and what shoe's going to drop next. If we take a look at the domestic equity funds, they lost really kind of the lion's share, $1.4 billion in outflow, 9th consecutive week that they've seen outflows, and they had a 1.04% return. Now, if we take a look at the non-domestic equity side, they only saw $47 million in inflows. Again, it was inflows, and this is for the 4th consecutive week that they've seen net new money come into their coffers, but they only had a 0.31% return. So it's kind of a little bit different. You know, we're seeing a lot of money come out of the conventional fund business, but really it's the domestic equity funds that keep taking it on the chin. If we take a look at it, large cap funds actually saw about $9 billion in outflow, and the international equity funds took in about $400 million. So again, not a lot to write home about, but certainly a head scratcher. We take a look now and contrast it to the equity ETFs. We see what the story is and kind of why I'm scratching the head. For the 5th consecutive week, we've seen inflows into this group. $8.6 billion this time. At the top of the group is the Spider S&P 500, took in about $4.6 billion, followed by a PowerShare QQQ Trust One, which saw about $1 billion. And at the bottom of the barrel, which was about 2 weeks ago, was one of the big shining stars, was Financial Select Sector Spider ETFs, and that lost about $517 million. And then the next worst was Russell 2000, which saw about $484 million. So we do see the authorized participant actually putting money to work into equity funds, while again the retail investor is pulling money out. A little bit of a scratcher. All right, let's move our attention to fixed income funds and see what happened in that arena. For the 9th consecutive week, we've seen inflows. This week it was to the tune of $1.2 billion. It's the 6th consecutive week that we've seen plus side returns, 0.29% this week. And at the top of the group, we saw corporate investment grade debt funds taking about $1.6 billion. 13th consecutive week, they've seen net inflows. And a lot of that can be attributed to loan participation, which is part of the corporate investment grade debt fund. I know loan participation is really not a corporate investment grade debt rated fund, but anyways, that's where the old group used to put that underneath. So loan partners are a big participant. $525 million net new money came into that group. It's the 16th consecutive week that we've seen money come into those type of securities, whether it be inflation protected or adjustable rate loan participation funds. Government mortgage funds were at the bottom, losing about $331 million. Let's turn our attention now towards the fixed income ETFs and get a little story on them. For the 6th consecutive week, we've seen inflows. This time it was $1.6 billion. At the top of the group was iShares iBox, investment grade corporate bond fund, taking about $856 million. iShare TIPS bond funds ETF actually taking about $330, and at the very bottom we saw treasuries. In particular, we saw the iShares 20 plus treasury bond ETF lose about $273 million. Well, let's go ahead and take a look at the muni bond funds. And this is where I was telling you that we had really kind of a change of pace. For the first week in 8, we saw outflows, this time to the tune of $241 million. Second consecutive week, though, that we've seen plus side returns this time, 0.25%. That's a pretty good number for a weekly return for a muni bond fund. And we did note that high yield muni bond funds took in $79 million, so most of those outflows occurred from single state municipal debt funds. Well, now let's turn our attention back to the money market fund arena. In the money market fund arena, I told you for the second week in 3, we've seen outflows, this time to the tune of $5.9 billion. And how it broke out is taxable money market funds saw $5.6 billion in outflow. And going micro on that, we saw institutional investors actually take out about $4.2 billion, while retail investors took out about $1.4 billion. Tax-exempt money market funds also saw outflow, but only to the tune of about $292 million. Well, that kind of brings us to the end this week. And, we heard some kind of not surprising news, but certainly some news that I think will keep people on edge. It actually helped the market stay quasi in positive territory today after kind of a little meltdown earlier in the day. Yellen basically came out and said, hey, March is a likely appropriate month in which to raise interest rates. And with that in mind, that just means she's thinking the economy is more robust than many people think. So this may be a good thing for equities, but again, it may put a little fear in people. They've certainly pulled the trigger on equities and bond funds when they heard of interest rate increases. But this time I think what we'll see what probably should be happening. Equities will probably do well. Bond funds will probably see some outflows. But anyways, my forecasting is not all that great. Probably as good as the next person's flip a coin concept. But anyways, if you want to do a deeper dive, though, in areas that I did not cover, you can go to our site, www.lipperusfundflows.com, or you can join us next week where one of our analysts will talk about flows and kind of give you that picture of what the Yellen influence was. Well, until next week, my name's Tom Roseen, wishing you the best in your wealth planning and creation.